So we proceed from where we left in our previous class. We had introduced ourselves on the topic, the mergers and what? Mergers and acquisitions, right? I want to do more questions on mergers and acquisition. And then on our Sunday class, we now introduce ourselves to the topic, portfolio theory and what? Portfolio theory and KPM. Najua mahali tuko. Yako uko wapi? All right. Mergers and acquisitions. Mergers and acquisitions. Mergers and acquisitions. Now we continue. When we do the question in the now we had already introduced ourselves on the mergers and acquisitions. And generally, when we talk of mergers, we said is a combination of two companies. Well, I said in a merger, no company dominates over the other company. All the company, what they will do, they lose their original identity. No one will dominate over the other. On acquisition, I said in this case is whereby one company known as the predator will acquire the other company known as the target. In that case, I say that the target loses his original identity as the predator maintains his what? Original identity. Now, our concern here, I said on the mergers and acquisition is the impact if it's a merger or the acquisition is going to have on the earning per what? Earning per share. Whether in this case it is going to change or to increase the earning per share or reduce the earning per share. Now, I want to just continue by doing more other questions. Do more other questions. We do in the sitting of August 20, late August. So I want to do in the sitting of, we do in the sitting of December 2022, question number 5C. December 2022, question 5C. December 2022, question 5C. Still do the mergers and what? Question 5C. By the way, when we talk about the earning per share, generally, it is always out of the profits attributable to ordinary what? Shareholders you divide by the number of shares. Mainly, these formulas zinatumia hapa mostly is just to help us to get that. But if you can put in mind that you are getting the earnings attributable to ordinary shares, you divide by the number of shares. should be good. Sawa sawa. Now we can do that question on question 5C. 5C of December 2022. Question 5C of December 2022. 5C of December 2022. So this is what we've been given. But, so this is what we've been given, that Alpha Limited and Beta Limited are companies operating in the same line of business. Given that in the recent past, Alpha Limited has experienced very steep competition from Beta Limited, such that Alpha Limited is considering acquiring Beta Limited in order to consolidate its market share. If they merge, that is what we call an horizontal merger. Given that the following data is available about the two firms, we've been given their the annual sales, we have the net income, you have also the outstanding number of ordinary shares, earning per share, and then we have what we call the market price per share. Both companies are in 30% income tax bracket. You are required the maximum exchange ratio that Alpha Limited should agree to if we expect no dilution in the post-acquisition earnings per share. Yes. So if we expect no dilution in the earning per share, so this is how we now be able to do that. A minute. So we can do that. So this is what we've said. To get a maximum exchange ratio, should be given by the non-diluting overprice. Diluting overprice. And this is by who? By predator. You divide by MPS of the predator. The MPS of the predator. So the first thing that I will do is to determine this non-diluting overprice. Non-diluting overprice. Now to get the non-diluting overprice, should be given by the price earning ratio. This is of the predator. You multiply by the EPS of what? EPS of the target. The EPS of the target. Remember I said to get the price earning ratio should be the earning market price per share. You divide by the earnings per share. So in our case here, we've been given the earnings per share, which is how much? The earning per share here. The market price per share we have is how much? We have the market price per share is 30. Divide by 3. Then I multiply by the earning per share of the target, which is 2. How much is it giving you? This will be given by how much? 20. Meaning that our exchange ratio will be the 20, which is now the overprice. You divide by the market price per share, right? This will give you how much? 0.67, which is 2 is to what? 2 is to 3. What does that mean? The predator will be giving the target 2 shares for every 3 shares of the what? Of the target. Every 3 shares of the target. For every 3 shares of the target. That is how in this case we get that. Ahmed, you saying I'm too fast. Okay, I'll say to get the maximum exchange ratio to be given by the non-diluting overprice of the predator. You divide by the MPS of the predator. Said for you to know the non-diluting overprice, when I talk of non-diluting is without diluting the ownership of that company. It will be given by the price earning ratio of the predator. And for us to get the price earning ratio is the market price per share over the earning per share. And then you multiply by earning per share of the target. The earning per share of the target. So market price per share of the predator, remember predator here is the alpha, is the one considering to acquire beta. And therefore the market price per share is 30, earning per share we've been given as 3. Multiply by the earning per share of the target, which is 2 shillings. So that from our formula here, the non-diluting overprice is 20. Then we have also the MPS of the predator, which is 30. You divide, you get 0.6666 that way, which is just equivalent to 0.67, which is just 2 is to what? 2 is to 3. Go to Roman number 2. Now, Roman number 2 is the Alpha Limited Force Acquisition EPS. If the companies agree on an overprice of 40 shillings. Now, this is the post-acquisition EPS. Acquisition EPS of the predator. Post-acquisition EPS on the predator. This is in case of share for what? Share exchange. Sawa. And we'll normally take the combined earnings. Share for share exchange, there will not be any impact on earnings when you issue shares. Ni kweli? Ama kuna impact on the company's earnings? No. Only thing that will increase here is the number of shares. So we'll take the number of shares of the predator. We had the now new shares to be issued to acquire the target. The new shares to be issued to acquire the target. How do we get these new shares to be issued? New shares to be issued To acquire the target here will be given by the exchange ratio. You multiply by the number of shares of what? The target. Number of shares of the target. So our exchange ratio, we're not going to use this one. The reason being that they have agreed at an overprice of how much? 40. So we're going to have a new exchange ratio, which will be 40 over 30. And then I multiply by what? The number of shares of the target, which in this case was 10 million. How much is it giving you? Remember, exchange ratio is overpriced. You divide by MPS of the predator. That is why I've taken the overprice. I divide by 30. Then you multiply by 10 million. To be equals to how much? Getting how much? How much is it giving you? Yes? 333. So that will be 13.33 million. So that now we can get the what? The post-acquisition EPS. Combined earning is just the net what? Income, the total net income. Net income for alpha is 150 million. Net income for beta is 20 million. Number of shares of the predator is having 50 million shares. You add the new shares to be issued to acquire the target. So what will be our post-acquisition EPS of the predator? What will be the post-acquisition EPS of the predator? What will be the post-acquisition EPS of the predator? Cosmos. 2.6. That is what was to give you the other 2 marks. Roman number 3. Roman number 3. Alpha Limited post-acquisition EPS or earning per share, if for every 200 ordinary shares of Beta Limited are exchanged for 5 units of 10% debenture of shillings 500 value. This is now what we call the share debenture what? Share debenture exchange. Share debenture exchange. Now on share debenture exchange, the only impact will be on the company's earnings because of what? Interest. So remember, on the number of shares, there is nothing will be affected. Here wanawapea debentures instead. So this is how we get the post-acquisition EPS of the predator. EPS of predator. Post-acquisition EPS of predator will be equal to the combined earnings. Combined earnings, you less the interest, but the interest you have to less the what? The taxation, because it's only for the net income, remember, is the profit after tax. The interest here, since you have not factored the taxation, you have to less the what? That given taxation. And then I will divide by the number of shares. This is of the predator. The predator shares will not change because here there is no new shares that will be received. So this will be how much? First, for us to know the interest, I need to know what we call the debenture capital. We need to know what is the total debenture capital. So we were told that for every 5 units of debenture, they will be given how many shares? 200 ordinary shares. And for every 200 shares, wanapewa 5 units of debentures. How many shares are they having here? They having 10 million shares. This will be equivalent to how many units? Be equivalent to how many units of debenture? Mm-hmm. 250,000. So that is 0.25 in millions. 0. Million that way. So then this is at how much? Each unit is trading at how much? 500. So it will be equivalent to how much? 125 million. This is the debenture capital. So I can look for interest on that debenture. The interest rate was at 10 what? 10%. What is 10% of 12.5 million? 10% of 12.5 million. How much is it giving you? This should be, 125. This should be 12 point what? Yeah, 12.5. So then, and get the post acquisition EPS. Combined earning will be 150. 20 minus 12.5 million. 1 minus the taxation. Then I divide by the number of shares of Predator. They were only 50. So how much is it giving you? Giving you how much? How much is it giving you? How much is it giving you? How much is it giving you? 3.22. So between the two financing options, which could be the best financing option? Is it share for share exchange or share debenture exchange? So where the earning per share is going to be more, which in that case is share debenture what? Exchange. That is if you are to advise on the best financing plan. So now we continue. Roman number 4. Combined operating profits. That is the earning before interest and tax, and post-acquisition earning per share at point of indifference between the earnings of the firm under the financing plan in C Roman 2 and the C Roman what? 3 above. Now, when we talk about point of indifference, we say it's a level of financing where the earnings before interest and tax and earning per share for all the available options are equal. Sawa. Yeah, a minute. So as I was explaining here, when we talk of point of indifference is where is a level of financing where the earning per share and also the earning before interest and tax for all the available financing options are the same. So it's one of the subtopic we'll talk of in what we call the special topics in what? Financing. So this is what I mean. At point of indifference, the earning before interest and tax in option 1 should be the same as earning before interest and tax in option 2. Same case, earning per share in option 1 should be equal to earning per share in option 2. So in this case, for the earning per share, it depends with the nature of financing. There is in case of all equity finance. Equity finance, we mean it is only financed by what? The ordinary shares. Like in our case in option 1. In option 1, it is all equity what? Equity financed. When I say it's all equity finance, is only financed by ordinary what? Ordinary shares. So to get the earning per share, we do say it should be given by earning before interest and tax. 1 minus taxation, you divide by the number of what? The number of ordinary shares. The number of ordinary shares. Are we together? So this is what I say. Earning before interest and tax. 1 minus taxation, which is 30%. I divide by the total number of ordinary shares in option 1, which were how much? 50 million plus 13. That should be how many shares? 63.33 million. So simply this will be 0.7 earning before interest and tax. I divide by 63 million. This will be my equation 1. I go to option number 2. In option number 2, the company will be financed by both the ordinary shares and also the debentures. So simply means that it is equity and debt financed. Equity and debt financed. Meaning that now to get the earning per share should be given by earning before interest and tax. You minus interest, 1 minus taxation, then you divide by the number of what? Ordinary shares. The number of ordinary shares. So in our case here, we know the earning per share in option 2 will be given by earning before interest and tax minus the interest. What was our interest here? 12.5 million. 1 minus the taxation, I divide by the number of ordinary shares. Here it was only 50 million. So I can solve that. This will be 0.7 earning before interest and tax. Take 0.7, you multiply by 12.5. 0.7 multiply by 12.5. Mbili nakupea ngapi? Yes? 8.7 minus 8.75 million divided by 50 million. So Earning per share in option 1, as we said, should be earning per share equal to earning per share in option 2. So earning per share in option 1 here is 0.7 earning before interest and tax. I divide by 63, 33 million should be equal to 0.7 earning before interest and tax, 8.75 divided by 50. Now I want to remove the denominator. Here I'll multiply by 50. Here I'll multiply by what? 60, right? 63, sorry, 63.333. I'm removing the denominator. So this will be 35. Earning before interest and tax should be equal to how much? What is 63.33 multiplied by 0.7? 44.331. 63.33 you multiply by 8.75 will be minus what? Huh? 8.75. 554.13 million. So like terms 35, 44.331 earnings before interest and tax should be negative 554,138. So if I minus there, this will give you how much? Hilda. Napotelea wapi? Juu ya hii is equals. I want to remove this denominator. So simply tunamaanisha you multiply by both of these two values. So hii itakuwa imecancel hii moja. This other one itakuwa imecancel the 50. We are removing the denominator 50. Ni kama hivi, I can also add 63.33. Hapa pia ni add 50. So 50 itakuwa ina cancel na hii. This one will also have cancelled with what? That one. So how much is it giving you here? Negative 9.33. Earning before interest and tax should be negative 554,138. So what will be our earnings for interest and tax? Divide by negative 9.33. Takupea ngapi? $59.9. That is a combined operating profits, right? So that now, if you want to get the earning per share, you can choose any of the equation. So I'll choose this one, 0.7 earning before interest and tax over 63.33 million. So this is 0.67, 59.39 million. I divide by 63.3 million. What will be our earning per share? What will be our earning per share. Zero point same 656. And that is how you are required to do that one. That is how we were required to do the question. There is only 11 marks. 11 marks. So I can also try one more, but meanwhile we can allow for Muslim to go pray. Then I'll come and do November 2019, question 5B. November 2019, 5B. So we can have a small break, then we come and proceed. We continue. We continue. Said we do November 2019. November 2019 should be question number 5B. November 2019, question 5B. November 2019, 5B. Now, I hope you know on 5A, we were able to talk over the types of mergers. You know what we mean when we talk about the horizontal merger, vertical merger. Cogeneric is also what we call the concentric merger. So the cogeneric is also what we call the concentric what? The concentric merger. Then also you know what is the conglomerate merger. So same for horizontal merger ni gani? Say the combination of two or more companies that are in the same line of what? Business. Also for the vertical merger, we say they are in the same industry, but in different levels of what? Production. Generic is a combination of what? Two or more companies that are in the same industry, but they deal with different products and what? Services. And then we have what we call the conglomerate, where you are combining companies that are unrelated. Mainly we say the purpose is for risk what? Diversification. A limited and B limited are companies operating in the same line of business. Hiyo ni kukuambia this is a what? Horizontal merger. In the first few years, A limited has experienced stiff competition from B limited to an extent that A limited is now contemplating acquiring B limited in order to consolidate the market share. The following financial data is available about the two companies, being given there the annual sales, the net income, ordinary shares outstanding, the earnings per share, market price per share. Both the companies are in 30% income tax brackets. So you are required to determine the maximum exchange ratio. The maximum exchange ratio that A limited should agree, assuming that it does not expect dilution in its post-acquisition what? APS. So how do we get the maximum exchange ratio? Say the maximum exchange ratio should be given by what? non-diluting overprice. Overprice. This is by the predator. You divide by the MPS of the predator. The MPS of the predator, right? So non-diluting overprice will be given by what? Non-diluting overprice will be given by the price earning ratio, which is the MPS over EPS of the predator. You multiply by EPS of the what? Of the target. The EPS of the target. So here it will be given by what? What is the market price per share for A Limited? B system. Earning per share is 4. Then earning per share of the B Limited is 3. So how much is it giving you? 45 shillings. So our exchange ratio will be 45 over the market price 60, which is 0.7 what? Is it 0.75? So which is the equivalent to 3 is what? 4. For every 3 shares of predator, you'll be acquiring 4 shares of the target. Roman 2. The total premium that shareholders of B Limited would agree to receive at the exchange ratio in what? Be above. Now, what is premium? Premium is when you issue shares at a price that is higher than bar value. Majorly the issue price of the company. Now, mainly to get the share premium, this is per share. It will be given by the overprice by the predator. Overpriced by the predator. You minus the MPS of the target. Sawa. Yani hii ndo the issue price of the shares of the target. Watakuwa wanachukua na hii overprice, ndio. But we were given the market price of their shares. So any excess will be our premium, which in this case, what is our overprice here? 45, right? 45 in how much? You minus 30, the MPS of the target. So this will be how much? It will be 15 shillings per share. So every share they will be able to get how much? 15 shillings. Pamoja. So itakuwa ya ngapi? What is the total number of shares? The number of shares to be issued. Tulisema it should be given by the exchange what? Ratio. So you multiply by the number of shares of what? Number of shares of target. So the exchange ratio here is 0.75. Multiply by the number of shares of the target. Ngapi? 3. So watapata ngapi? How many shares will be issued? 2.25 million. For each share atakuwa anapata 15. So what will be our total premium? It will be 2.25 million. I multiply by 15. Total premium will be over how much? 33.75. That is what will be our total premium. First, you need to know the share premium. Then you can also get the number of shares to be issued so that you can be able to know the total premium. Roman number 3 is the A limited post-acquisition EPS, assuming that two companies agree at an overprice of how much? Overprice of 30. Now, this is the post-acquisition EPS in case of share for share exchange. So, for the acquisition, EPS of the predator will be given by what? Will be given by combined earnings divided by the number of shares of predator. You add the new shares to be what? New shares to be issued. Now, what will be our new shares to be issued? The new shares to be issued here, it will not be this amount here. No, not this one. The reason is because our exchange ratio now will be different. Right? Our exchange ratio will be different because of the overprice. It is not now 45, it is 30. So I will just check the exchange ratio, which is 30 over 60. I multiply by the number of shares of the target, which is 3 million. How much is it giving you? How much is it giving you? Hmm? 1.5. So what is our first acquisition EPS? The combined earnings, which in this case the net income was 14. Yeah, 9 million. Then you can divide by the number of shares of predator 10 plus 1.5. How much is it giving you? Four point 4.26. Go to Roman number 4. Roman number 4, they want us to determine the A limited post-acquisition EPS, assuming that for every 100 ordinary shares of B limited are offered for 12% debenture of shillings 500 value. This is now in case of a debenture exchange. So debenture exchange, how do we get the post-acquisition EPS of the predator? Post-acquisition EPS of the predator will be given by the combined earnings minus interest, 1 minus taxation, the number of shares. This is of the predator. Number of shares of the predator. So in this case, will be first we need to know the debenture what? Debenture capital. So we were told that for every 2 units of debenture, it will be given how many shares? 100 shares. We know the shares are 3 million shares. So this will be equivalent to how much? So that will be 0.06 million. I multiply by the value, which is 500. That means it should be 30. So what we want is the interest. Interest here, the interest rate was of 12%. Multiply by 30. This should be 3.6 million. 3.6 million. So we can get the post-acquisition EPS. Combined earning is the total income, net income, I minus interest, 1 minus taxation, which is 30%, number of shares of Predator, 10 million. How much is it giving you? Four point 4.648. That is how we do that one, right? Any question? Let me do one last question. So that now the rest we meet in when we be doing revision, question 5A. And I make sure that you practice on this topic. This sitting team must be there. The mergers and acquisition. Now December 2021, we check on question number 5A. December 2021, we check on question 5A. Songo Limited has decided to acquire Twiga Limited. Financial data for the two companies was given as follows. Given the net sales profit after tax, you have the number of issued shares, the earning per share, we have the dividend per share, the total market capitalization. Yes? Yeah, December 2021. Oh, not December, should be April 2021. April 2022, sorry. April 2022. April 2022. Should be April 2022. Question 5A. Should be April 2022. Question 5A. Songo Limited has decided to acquire Twiga Limited. Financial data for the two companies are given as follows. Given the net sales, profit after tax, number of issued shares, earning per share, dividend per share, total market capitalization, and then you are required the free acquisition market per share of the combined firms. Free acquisition market per share for the two companies. Free acquisition market per share should be given by the total market value. Just divide by the total number of what? Number of shares. So the total market value is 420. It is just the capitalization. You add 45. Total number of shares, this is 7.5 plus 1.5. Takupea ngapi? How much? 50 points. That is the market price per share. Roman number 2, the post-acquisition EPS. If Trigger limited shareholders are offered on an exchange share for share exchange. Now this is post-acquisition EPS of the predator. EPS of the predator. How do we get that? To be the combined earnings you divide by, this should be combined earnings, you divide by the number of shares of predator. This is of predator. You add the new shares to be issued. New shares to be issued. Now, passing that we don't know the market price per share. So let me look for market price per share on a songo here. What will be the MPS? To be the market capitalization 420 divided by the number of shares, which is 7.5. No. The one here, it will be how much? For MPS of Trigger should be how much? Should be 45, you divide by 1.5. Inakupea ngapi? Huh? This is 56. Ingine? 13. No, I want to know the new shares to be issued. Shares to be. Huh? That new shares to be issued. New shares to be issued should be given by exchange ratio multiplied by number of shares of the predator, of the target, sorry. So exchange ratio will be given by the overprice by the predator, which here it is 30, divided by the MPS of predator, 56, multiply by number of shares of the target, 1.5. How much is it giving you? It is giving you how much? Zero point 8, 03. 804 itakuwa sawa. So that our combined earnings will be net income, which is a profit after tax, and 8.13. You add this other one is 3.75. I divide by 7.5 plus 0.0804. How much is he giving you? Two point one three. If the price earning ratio of Songo Limited drops to 12 times, this is after the acquisition, you are required to determine the post-acquisition market price per what? Share. Itakuwa ngapi? What will be our post-acquisition? Ni post-acquisition ama pre? Post-acquisition EPS. How do I get that? Tuipata aje? How do you get the price earning ratio? Price earning ratio should be given by what? Si ni hiyo MPS over EPS. Si mimi nataka hii. The MPS. I know this is 12. Should be equals to MPS earning per share average 2.94. So what will be my MPS? To be 12 you multiply by 2.94. Hivyo tu. At 5 point. We have the price earning ratio. So now that we have the price earning ratio and I know the post acquisition earning per share. So from there it will help us to get that. You are to formulate a suitable criteria that should guide Sogo Limited in determining whether to acquire Trigger Limited or not. Formulate to them a suitable criteria. This is now to help them to know whether in this case they should acquire Trigger Limited or not. Hiyo ni nini? Generally, these are the steps in mergers and acquisitions. Sawa sawa. You know the steps in mergers and acquisition. I said you read them from the handout. Then I shared with you the handout. I'm not your adult. You have the handout on there is advanced financial AFM theories. If you take on this should be page what? 11 there. There is the steps that you use in mergers and acquisition. So the step number 1 is merger and acquisition strategies. Merger and acquisition criteria to be used. Identify or search the possible targets. Now, mainly when I talk about criteria, we may talk of it in forms of kuna either what we call the share for share exchange, or you may talk of what we call the debenture exchange. Share debenture exchange. Ama what we call, generally we are talking about the consideration. Unataka kutumia gani? You want to give them shares, you want to give them what we call the debentures, etc. But in the most of the cases, even when you look at the question that we have both done, for share debenture exchange, the earning per share is always higher kwa zote. Ama hujaona hivyo? Umeona hivyo? I think out of all the question, the share debenture hii ndo inakuwa mingi. Sawa sawa. But generally, here is just to formulate a criteria. First, you have to come up with the mergers and acquisition strategies. And then you talk of the criteria, whether they supposed to use the debenture exchange or what we call the what. Okay, just write this. Just write this. Say Songo Limited should first consider or should first come up with the mergers and acquisition strategies. Mergers and acquisition strategies. Number two, what do you say? They can consider share for share exchange or debenture exchange. Share for share exchange or debenture exchange. Debenture exchange. Depending on the impact. Depending on the impact they will have on the earning per share. Depending on the impact of the earning per share. The one they can identify the possible benefits. Possible benefits to be realized from the merger or the acquisition. The merger or the acquisition. Another one, same. They can have a financing strategy of the merger and acquisition, plan. The merger and acquisition plan. Now, basically, that is what you can be able to talk about in that case when they talk of you formulating a criteria. Just help them to know how they can do what? The merger and acquisition. Do the following as assignments. So the next class will now be doing what we call the what? Portfolio theory and CAPM. Portfolio theory and CAPM. Think now the topics that we'll be covering are now the most crucial topics. Kama mjui, we are only remaining with 5 topics. We are not aware. It's only on the portfolio theory and CAPM. There is a financing decisions, corporate valuation, derivatives. Hizo ni ngapi? Nne? Yeah, ni hizo. But I think portfolio theory is quite examinable. Mostly is most of the questions it covers more at least 30% in portfolio theory and CAPM. And then there is also the capital structure theories on financing decisions. Yeah, from now all the topics you are expecting them. Capital structure theory and what we call the cost of capital is part of what we call the financing decisions. And mostly they do interchange. Kama wameset on cost of capital, you expect the other sitting on what we call the capital structure theories. So, but the widest is that one of financing decisions. Yeah, so msione ati tunamaliza haraka. Financing decision, it has to take us at least 6 classes. Sawa. Yeah, but is also another topic that is highly tested. Same case to this one nimesema hapa, mergers and acquisition. This one is the mass. Expecting a question of at least 10 marks. Sawa. So you just do the following as assignment. You do the following as assignment. Do April 2024, question number, no, that is not on the same EOC Evo. So you do in the sitting of September 2021 5C, September 2021 5C, May 2021 question 4B, May 2021 4B, May 2021 4B, I'll also do in the sitting of May 2018 question 3C, May 2018 question 3C, May 2017 question 5A, May 2017 5A, yeah, just do that one. Yeah, just do those questions. So we meet on our next class, portfolio theory and CAPM. It will just take us at least 3 classes and we're done. So continue from there. Maswali?